Good afternoon, ladies and gentlemen, and welcome to the Reach PLC half-year results investor presentation. Today's presentation contains no new financial or price-sensitive information following the publication of the half-year results this week. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard and will notify you by email when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll, and if you would give that your kind attention, we would be most grateful. And I'd now like to hand over to Matt Schaff, Jim Mullen, CEO, and Simon Fuller, CFO from Reach PLC. Good afternoon to you all.
Good afternoon. Thank you, Mark. Good afternoon, everyone. Thank you for joining, and I appreciate your time and interest in our company. I know you have enough opportunities to look at, so we don't take it for granted. So we'll try and give you as much information as we can today. I'm just going to, I've also got my CFO, Simon Fuller, here, who will be taking over the financial and the operating details, and I will take you through the transformation and then go on to the strategic delivery. So I'm just going to switch off our cameras and start with the presentation. So, firstly, I'll speak about how we've transformed the business over the last 16 months. The previous 6 months to that was the evolution of our strategy, and we didn't waste any time in its application. And before we start that, I would just like to remind everyone, because not everyone knows this, about the scale of our organisation. We're the largest commercial news publisher in the United Kingdom, and by a significant distance, we're also the largest sports publisher, commercial sports publisher in the UK. As well as that, we're actually the 5th largest digital asset in the UK as well, behind Facebook, Apple, Amazon and Microsoft. We're the only UK platform against those American tech platforms. And it's important for you to understand that, because every month we access roughly 43 million online individuals in the United Kingdom who consume our news and our sport. Now, that's obviously the opportunity for our company, the ability to grow our digital business and the opportunity that's in front of us. But we're also well-funded, and we're well-funded by essentially our newspapers. Now, there is, to use the phrase of Tom Sawyer, the exaggerated news of our death, i.e. the death of newspapers, is wrong, because it's not the case. We have 9 national newspapers. We have 110 regional newspapers. That goes through 50,000 retailers. And we sell 8 million newspapers every week, which is not an insignificant number. And we have found that audience for newspaper buyers has been super resilient during the pandemic. We were actually genuinely surprised ourselves about how people will make sure their habits of getting their daily news is basically delivered. And that is one of the reasons why we're in such a strong position from a cash position, because that also helps direct fund our digital business. Our online audience in the UK is roughly 80% of the UK digital population. What does that mean? It means that every brand and advertiser will at some point go through us to reach their audiences. And obviously we satisfy that audience demand by publishing nearly 900,000 stories last year, and that's up 62%. And with that sport audience that I spoke to you about, the gap between us and the second most popular sports media publisher is around 20%, so we are not insignificant. Now, people are often surprised by that. They shouldn't be, because I often say to my team, all news is local. And sometimes when you follow primarily, say if you follow football, you think that football is maybe 6, 7 or 8 teams, because that's all Gary Lineker and Alan Shearer talk about. But actually football is local. So if you want to follow Bristol Rovers or Yeovil Town or Ipswich or Motherwell or Dundee or Swansea or Exeter, then it's usually through our titles. And when you add up all of the followers of those clubs outside the big 6, you'll actually find it significant, in fact, even more, as the response to the European Super League had proven There is a lot of local clubs in local regions, and the only way they can get that content is through our sites and newspapers, which just proves the value of what we do. Now, we are now on a clear pathway to profitable growth. And I always start this point with saying that we now employ more journalists than we did in 2019. Now, despite there being a global pandemic, and the consequence of that pandemic has been an economic crisis, which we haven't seen since the Wall Street crash of the 20s, we're still employing more journalists than we did before the start of it. And I think that's a significant point. Why? It basically means that the only reason we can employ journalists is because we can afford to. And the only reason why we can afford to is because there is enough ad inventory to actually, there's not enough ad inventory, but there's enough ad inventory at the moment to satisfy the demand for our readers and customers. So the more journalists that we provide, the more demand and eyeballs that we create, and the more ads that we can sell. And despite some of the naysayers who are talking about the difficulties in the UK economy, the UK economy is still ticking over. We're seeing that because we are selling more advertising and we have more people coming to view it, and therefore we're employing more journalists to do so. In order for our brands to maintain that position of being a trusted source, then we continue to be champions, campaigners and change makers. And we take this seriously. In a world of fake news, in a world of where is the source of my news coming from, in a world where I'm sitting at home, how do we affect change and for things to happen? Well, our titles do that. And in the last 12 months, we've changed 4 laws. We've represented communities who are underrepresented, and that creates a loyalty within our newspaper base. If you take the Mirror, the Star and the Express, we're lucky enough to have 3 titles which naturally, socially and demographically self-select. The Mirror is obviously a left of centre title. The Express is right of centre. And the Daily Star, even though some people think that it's a humorous publication, it's actually more than that. The Daily Star is now carrying the tradition, the great British tradition of lampooning those in power, where it used to be Private Eye, and back in the 70s it used to be Monty Python. Actually, it's now the Daily Star, so it actually has a serious purpose. If you think that you can get away with things, then both are right and left-leaning national titles and our regional titles will address that, but the Daily Star will come and get you and make fun of you. So we're keeping an eye on those in power, and that's important because it's attracting audiences. They trust and believe our content, which means that they're more engaged than they were ever before. The big challenge, obviously, we have for our business is that we have to transform and transfer our business into a digital platform. And when Simon and I started in the company a couple of years ago, one of the main reasons that we came was that here was a company which was the 5th biggest digital asset in the UK, reached 42 million, it was roughly 40 million when we started. And we asked the question, how much of that audience do we know? I.e., who's registered? What's on the database? Do we know that this individual is particularly interested in sport or politics or entertainment? And when we asked the question, it was roughly 200,000. Therein lies the opportunity. Because we know if we can get content to people at the right time, we can keep them glued to that content for longer, and we can give them advertising where the propensity for them to click through is much higher. That's where our digital shift and our re-rating will go. But it gets better than that. If you look at digital-only businesses that are similar to ours and you look at their value multiple, it's 10, 12, 13, 14 times. Now, why can't we get that? Because we have something that they don't. We have a resilient newspaper business, which is actually funding that digital transformation. And Simon will speak later about our operating margin. He'll speak later about the transformation. He'll also talk a wee bit about the fact that this newspaper audience is super resilient and sticking with us. And even though there's some negativity around an audience that's in decline, yes, it is. It's getting smaller, but it's not getting as smaller as you think. We have done the mortality models that look at the average age of our newspaper audiences between mid-50s and late 50s. The average mortality rate in the United Kingdom is 25 years. Even if you layer on the decline rate, there is decades of loyal purchasing readership in our newspaper business. It is highly cash generative, and it is basically an interest-free funding vehicle for our digital business. much more than those large digital properties can get on their multiples on unprofitability. That's the key, and it's something that you need to understand. That enables sustainable and profitable investment in journalism and content because we have the cash and we're growing our digital business. Our digital business grew at 43%. And that in itself pays for itself with additional funding from the newspaper business. We are now on a clear path to long-term sustainable growth. We do not have to buy other newspaper groups to squeeze out synergies to buy us another 6, 12 or 18 months. We are self-sufficient. We are now investing in journalists. We are investing in tech and platforms. This business is transforming. It's different from what it was 2 years ago. So some of the key highlights. Part of our strategy has actually been to get customers to register. Of that 42 million, we already have 6.7 million customers who have registered with all of our titles and live sites. And we are actively every day, every hour, every minute as they engage, we are picking up information about them, what they read, when they read it, how long they read it for, what story they click on to next, what email, what comments they make. We are building a profile of our customers through the registrations. That has helped us grow digital revenue to 43%. It's also showed you that digital is now almost a quarter of our business compared to what it was in H1 2020, and it's actually greater than print advertising. Our position has been number one for sport in a summer where we've had the Euros. The Olympics is still to come. Track and field is still to come within the Olympics, where you see a sharp uptake, and then obviously the football season starts again, not to mention the Lions on tour. Then it's no surprise that our sports business is growing. And then circulation, that's returning to post-COVID levels. I'll leave those numbers to Simon, but we've got low single-digit decline. Last year, during the COVID pandemic, we didn't know what to expect, so we went through a transformation program. Now, that transformation program is coming through. Credit to our executive team for delivering it, and we've got nearly 23% operating margin, the best that it has been for some time. That's left us with 55 million of net cash, even though we have a lending facility. And at half year, we've got 55 million of cash to support our business. That is the highlight of what we've done in H1, and it's slightly ahead where even Simon and I expect it to be. We are in a positive place. We are in root health. So let me hand over to Simon just to give you some of that evidence around the financials on those numbers. Simon, just over to you, sir.
Thanks, Jim. Good afternoon, everyone. Thanks very much for joining this webinar. So I'm not sure how much you followed the company. I can see from the poll that quite a lot of you are shareholders. So you'll perhaps remember that 2020 was a year of transition for us. Jim's just mentioned the transformation, the launch of our new strategy, which we launched about a month before the first lockdown relating to COVID. And really that was an accelerative year. But what we always described through the course of 2020 was that was about building the foundation for 2021 and beyond. And so what I'd like to sort of take you through over the next 8 or 10 minutes is a little summary of where are we seeing that progression? What are the proof points, as Jim's been describing, of the strategy working? And what should you expect next as we continue that journey? So if I start with the financial progress, we describe this as an ahead of expectations performance. Ahead of our expectations and also ahead of analyst expectations in terms of the writing and the research that's in the market. And that really can be summarized across a number of the P&L lines and also progression on the balance sheet. So in revenue terms, as Jim's already mentioned, we actually had total revenue growth and also like-for-like growth. So revenue growth of 4%, like-for-like growth of 2.6%. And I think there's a couple of things I'd want to call out about that. One is that somewhat reflects a bounce back from COVID. It does show the resilience of our print business, and both circulation and print advertising were actually in like-for-like growth in Q2. But more than that, it also demonstrates the larger digital business now, which is a growth engine within the overall business. It's a testament to the mix change that we have now, that our digital business, with the growth rates that we're now achieving, is able to drive a level of total company growth. And that's clearly a significant moment for the business. On the cost side, you'll see in front of you that the cost stayed broadly stable, actually slightly lower, 1.3 million lower. Now within that, there's a lot of moving parts. You might remember that in half one 2020, we put a number of people on furlough. At its peak, we put about 1,000 people on furlough at the toughest point of the pandemic, particularly in our regional business. We also put in pay cuts. We suspended bonuses. This was all at the toughest point of the pandemic in order to protect the business. Now, as we moved through 2020, those measures were relaxed and reduced. And that was as we saw revenue recovering, as we saw digital acceleration. And in 2021, none of those measures are in place. Everything is business as usual in terms of the cost base. And yet, even with that extra investment and none of the benefit of those one-offs, and with a higher revenue number by 11.5 million, as you can see on the screen, we were actually able to reduce costs. And that is because we're now running a much more efficient operation. Through the course of COVID we did was we looked at the end-to-end business model. We looked at editorial, commercial and back office operations. We looked at our printing functions. And more recently, we've looked at our office estate and transformed us to a 21st century business, a business that's ready for 2021 and beyond. And we've looked at all of the different structures and improved our efficiency. And that's what's driven that operating margin improvement in part, alongside the benefit of a bigger digital business, which is margin accretive. And you can see the operating profit move forwards 14 million. The margin, as Jim's mentioned, moved forwards just less than 4%. The same story flows through to EBITDA, our earnings. We're pleased to announce a 2.75 pence dividend per share. That's up roughly 5%, just shy of 5%. And that demonstrates our confidence to pay a cash dividend. Our stated policy is to grow our dividend over time. And we believe we can successfully do that in conjunction with investing more in the business for organic growth, and also continuing to meet our pension obligations and so on, all of the other stakeholder obligations. Operating cash flow, you can see, was very strong in the half, up 30%. Net cash, similarly, up 30%. And then the other call out was our net pensions deficit. So that's net of deferred tax, because as you'll be aware, when we make a pensions payment, we're able to claim a tax deduction on that. That deficit came down significantly, and that's laid out on the slide. That's because we saw an increase in the discount rate, so reducing our future liability. And look, that's similar throughout the marketplace, based on forward views of interest rates and yields. But from our perspective, it's a further strengthening of our balance sheet. So I've said a significant year or half year of financial progress. Let's just dip into some of the details a bit more. So this slide shows something of the digital revenue progression. And as you can see from the left-hand bar chart, we've seen a real step forwards in our digital revenue. In fact, for both 2019 and 2020, digital revenue was in the 40s of millions. In fact, it was also in the 40s of millions in 2018 as well. And you can see that the mix percent of our total revenue was in the teens. In 2021, we've now broken into the 20s, well into the 20s. And the digital business we have at £69 million in the first half is equivalent to our full year digital business only as recently as 2017. In fact, just to remind you, our total digital business, annual digital business in 2015 was £30 million. We've now done more than double that in the first half of 2021. So you can see that there's been a real acceleration in the digital progress, particularly in the last 18 to 24 months. We've seen a growth, which is the middle chart, in our unique visitors or our unique audience. This is what makes us, as Jim's already mentioned, the 5th biggest digital asset. And then just worth a comment on the worldwide page views per month. The piece that we particularly call out is the 2-year growth, which you can see on there, up 24%. And we did have some 2020 volatility due to COVID, particularly during the lockdown months, where everyone was stuck at home, perhaps accessing a disproportionate amount of content, particularly around COVID topics. And that did particularly boost our traffic. But we are still showing steady progression on an underlying basis. And that's really important because it demonstrates the engagement with our product. If I then just move on to the way in which our mix has changed comparing to print advertising. And again, I've gone back this time to 2015, just as I did a moment ago with the voiceover of the total mix. And this really demonstrates how consumer shifts have happened, as well as how our business focus has evolved over the last 6 or so years. And you can see that in 2015, we had a 14% of our total print advertising plus digital was digital. It's now 58%. And that's on actually an increased overall 12-month quantum. So you can see how much things have shifted. But if you look at the right-hand side of that bar chart, you can see that it's particularly shifted over the last few years. You saw a very big shift from 2019 to 2020. And that actually was the inflection point where print through the course of 2020 print advertising became smaller than digital. And that's clearly a very important moment in terms of the mix of our business and the benefits that come from that larger digital business. Jim referred to the robustness of print revenue, and this slide has got quite a lot of data on it. I recognise that, but we're trying to capture quite a complicated story. But you can see on the bar chart as you read from left to right how significant our print business still is and how robust that has been. Both circulation and advertising were in like-for-like growth in Q2. Advertising by over 20%. Circulation by a small single-digit percent. But the thing that's very important is that circulation now is a very significant part of our print revenue, almost 70%. You wouldn't have to go back very many years for it to be more like 50% or 55%. So why is that important? Well, in the longer term, circulation revenue has a slower decline rate. And that's because we can protect that revenue through cover price inflation. We've been successfully able to put in cover price inflation for many years now as a business. Our business still represents, or our products still within our business still represent very, very good value for money, as we believe. 55p to buy the Daily Star, or 90p to buy the Daily Mirror, 75p for the Daily Express. For a 64-page book as it is, we think that represents good value for money, and therefore we are able to continue that cover price inflation, which does protect that revenue stream. Print advertising is still a scale business, and throughout COVID, we've continued to have strong print advertising from food retail, from telecoms, from financial services, from home leisure, and really it's only certain sectors that are yet to recover to where they would have been, and particularly we think of areas like travel and out of home leisure. Jim's mentioned the operating profit progress we've made and the operating margin progress we've made. The aspiration that we have, which is 25% plus longer term margin, we feel is very achievable, and that's not on the basis of continuous cost cutting. That's not on the basis of squeezing the margin in a unsustainable way. This is about investing for the future. It's about growing our digital capability as our digital mix becomes larger, and because it's got a larger margin in the longer term, that will be accretive. That will add to our company margin, and therefore sometimes we are asked, is the current margin that you've got the end of the journey? Is that the end of the story? And we are very clear that it isn't. And then just in conclusion, strong adjusted operating cash flow. We actually had a more than 100% conversion of EBITDA profit into operating cash flow, partly because of a working capital swing. Some of that, it was seasonal. But even putting that aside, we're a highly cash generative business that can meet our historical obligations, such as pensions or historical legal issues, can pay a strong dividend, and also can retain cash and invest more cash in organic growth or acquisitive growth. And so we continue to have high levels of confidence. Jim mentioned it earlier about the continued cash generation of the print side of our business, but also the cash generation of our digital business, to be able to recycle that not just to grow the margin, but also to continue to improve our future prospects. And then just very finally, our capital allocation framework is relatively simple and straightforward. We have a positive net cash. We have a strong and strengthening balance sheet. In the past, we have taken bank debt to expand, and we would consider doing that for the right value opportunities, but we will be very picky and make sure that it does meet the necessary hurdle rates. But in terms of the customer value strategy, we will continue to flow in investment. Since February 2020, we've flowed in around about £20 million of additional investment into the customer value strategy and content. We will continue to meet our pension obligations. And as I've said earlier, we have a policy to grow our dividends. So that's really it from me. 2021 is a really important year. It's a year of demonstration of the strategy. And if you look at the first 6 months, we think there's a lot of proof that the strategy, the customer value strategy, is working, and that is, as Jim said, transforming our prospects. I'll hand back over to Jim.
Thank you, Simon. So look, that was the numbers behind the progress that we've made so far. So let me just talk for a wee bit just about our strategic delivery. Now, some of you will be aware of our strategy. Some of you, it might be new to you. So let me just briefly go through what it is. The strategy is essentially, it's about getting to know our customers better. And if you get to know them better, then you can extract more value. So how do we do that? Well, firstly, we increase customer engagement. So making the experience much better, build relationships, etc. Give them content that they're interested in. That could well be, if you're reading the Liverpool Echo, there may be content in the Daily Record in Glasgow and What's On or Politics or in the Mirror that you might not be aware of. So using the power of our network to give content to particular readers who may not have accessed it because they deal with one title. We also need to build a single view of the customer. Now, a lot of you will have heard of this term before. Essentially what it means is we build a profile of customers. So like Google does already, or Facebook, and with your cookies, when you go online, everything that you do has been tracked. Well, we do it the same, but we do it within the trust of the brand. And when you register, or whether you sign up to a newsletter, a Reach ID is allocated to you. So if you're reading a story about the European Super League and then you go and follow European football, or if you want to know about vaccine efficacy, all that is tagged to you. So as we know the information that you're interested in one single view. Where did it used to be? Well, if we had it, it was on numerous databases throughout the company. Now we have one single view of that. That allows us to grow revenue and diversify. So how do we do that? Well, at the moment, 2 years ago, we would basically have a yield in the market for an advertiser that wanted to access anonymous eyeballs. Well, what we do now is we build products for specific advertising segments. So whether it be gambling, betting, leisure, travel, food retail, non-food retail, we're actually diversifying into specific segments. And we're building products to allow us to do that, to grow and diversify our revenue base. And then all of this is undermined by an environment where people want to work, and by capability. So we've brought in brand new capability on data analytics. We've brought statisticians in, software engineers, computer programmers, data analysis. And we've also brought in more journalists. But in order to make that work, we need to build a culture. And I'm going to talk a wee bit about the culture we're building, particularly post-pandemic. So how will we double the digital revenue in the company? Well, the first thing we need to do is that we need to understand who our readers are. So we're not going to put out a big questionnaire. We don't want to know. You don't have to fill a form in. All you have to do is register. And how do you do that? Simply via your email address. Because as soon as you put your email address in, signed up for a newsletter, or put your postcode in for in your area, just one piece of information, we allocate an ID to you. It's like your cookies that are on your laptop. We will therefore actually record, and it sounds a bit sort of dystopian, but it's not. We record which content you're looking at. We also record when you're looking at it. That's really important, because if an advertiser wants to get your attention, don't send an ad to me at, say, 5:02 on a Thursday when I'm basically presenting to retail investors. send it to me at 7 in the morning, because that's when I'm fully engaged. That's when I am fully engaged. So even the time you look at content, we can record that and make your experience more worthwhile. And that's only because you've registered. Then through engagement, we give you the right content that you're interested in. So there might be content that you come across, and we still want our customers and readers to have that experience of browsing through the Manchester Evening News and finding something that they didn't expect they would be interested in. That's the beauty of reading content on an edited site. But also there'll be the time when you're interested in the transfer window or amber list countries going from amber to green. And at that point, we have targeted engagement. And then the content, we need to produce it, which comes back to the point of employing more journalists. And this is journalists, not content or clickbait creators. This is proper journalists who can write, who can introduce you to a story, who can keep your attention and actually leave you waiting for the next chapter or the next piece of breaking news. That's a skill. It's the ability to tell a story. And that's why we're obviously employing more journalists. Everyone thinks they can write, but actually when you read a good piece of journalism, you know the difference. And then finally, product development. In the past, we weren't very good at this, but the products now allow us to actually provide more targeted advertising to this content. And I'll speak a bit about that later in the presentation. So registrations are advancing. We have a target of 10 million by the end of 2022. I'll go out on a limb here. We'll hit that. The 6.7 million registered customers that we have at the moment has been growing by just over 30% since the end of 2020. Now, granted, COVID did help. When you have an audience of 42 million and a lockdown forces them to stay at home, then your digital, obviously, registrations and engagement should go up. So we don't take any credit for that. The actual COVID lockdown did help us accelerate. But look, tell you what, being a CEO and a CFO, it's nice now and again to get a tailwind. So we did get that, which was one of the benefits from this drastic COVID impact that we've had. Now, where's it coming from? Well, newsletters has been one of the biggest. Newsletters is really interesting because newsletters cover every aspect of content. So to give you an example of one of our most engaging pieces of content was the BBC series, Line of Duty. Now, it only lasted for 6 weeks, but the intensity of engagement and the newsletter content that we gave around it actually got people to register. Love Island, that impacts a much younger demographic, and even though it's an ITV programme, the content that we produce actually attracts a bigger audience online. So our newsletters around Line of Duty and Love Island are very, very positive for us. And then you have your traditional newsletters, which are segmented by your audience. So the recent incident of the Royal Navy and the Russian fleet nudging each other in the Black Sea was quite attractive to a Daily Express audience who are, by default, are older, right of centre. Defence and defence and safety is quite important to them. So we found a big uptick in that story from that audience as well. So we have newsletters that apply to numerous different types of content. We then have a product called In Your Area. Now, In Your Area was very valuable to us during the pandemic because you could go and see instances of COVID infections within your postcode area. It became a place to go to find out how the pandemic was impacting the local community that you lived in, not just a small town or a small city, but actually maybe just at postcode level. An interesting thing about In Your Area, it's built around postcodes. Now, postcodes are a hugely valuable piece of data. In fact, if you have someone's postcode, you can pick up so much information about their demographics, where they live, what their interests are, and we tie that into our overall customer profile building. So that's been very beneficial for us. Engagement is growing. Page view is actually how much time people are watching the pages has went up during the pandemic. Granted, if the quality is good enough, you should accept that. So we don't take credit for that. We think our quality is good enough. 2-year active growth rates are probably more indicative because that takes out the pandemic outlier, and that's been strong. And then obviously our engagement against the publishing sector and the internet in general, bearing in mind we are not just competing against other publishers, we are competing for people's time. So when someone's buying a book or an item on Amazon and they're reading someone else's review, that's time that they're taking away from us without reading our content. So we keep a close eye on this, but we are punching above our weight on it. We're doing very well, which is no surprise since we are the 5th biggest digital asset. And that loyalty is continuing. Even though people have come out of the lockdown, there's no sign of it abating. People are now used to where they get their content, and we're still seeing that progress continue. Content's broadening. So we're obviously seeing interest in topics that we never had a product. So for example, Northern politics, the fall of the what was known as the Labour Red Wall, who's basically seen an area where we need to address, talking about issues in the north and obviously the Northern Powerhouse around Manchester. People are taking more interest in their region. They're looking at the likes of Scotland and Wales having their own devolved parliaments. What does that mean for the likes of Manchester and Leeds and Newcastle? So we've built content around this to support the debate. Black Lives Matter, gender equality has created a real demand for content around that. So we're serving that through our Inspiring Women and their ethnicity programs. And then in the short term, and the great thing about news is everything is in the short term, or so much so. So the Euros, the Olympics, the British Lions have been real high bursts of activity. And we make sure that our news desks are now ready to see what's coming. A couple of years ago, we would start talking about the Lions tour, maybe a week or so before it started. We are now planning months ahead of how do we impact it, what do the customer profiles look, how much should we be releasing the newsletters, how many newsletters should we release, should we do player profiles. The planning that goes into our content burst now are much more sophisticated than it used to be. So this is the product I was talking about how we diversify our growth. In the past, if you wanted to sell, let's see, fish fingers through Reach or frozen food through Iceland, you would do a campaign in our newspapers, you would take over our digital websites, and we would sell you what we call a big city package, which is essentially, because we are the only news group that has regional and national coverage at scale, we can say, well, we can get you a brand campaign in the nationals, but we can also put it in Newcastle and Glasgow and Manchester and Bristol. Now, that's quite effective, and we still do that, and it is very effective. But what we do now is take it to another level. We say, not only do you want to sell maybe some frozen products in your food retail, and you want to get your brand out there, but you may be opening up new shops, say in Greater Manchester, or in Lanarkshire in Scotland, or in the West Country. Because of our ability to understand where these customers are, you don't have to pay for a campaign across the nation. You can actually pinpoint the people who you need to get to. Now, that might mean that the campaign, you might do one campaign at 100,000. We can now do campaigns where you'll do 6, 7 or 8 at 25,000 because it's highly targeted. Now, we can only do that because we understand our readers better. And we've done that for a number of the segments, and we are seeing highly targeted campaigns are delivering a marked improvement in effectiveness. What do I mean by effectiveness? The propensity for a reader to click through an advertisement that is served to them. So here are some of the sectors where we've seen improvement: 46% betting and gaming, 20% education, even travel, which has been hit pretty hard, i.e. becomes more competitive. Staycations have uplifted by 36% because we are targeting people who are looking at staycation content. And I'm going to come on to a case study just to show you how that actually works. One of them will be, if you take betting and gaming, normally during a Euros final, the gaming companies would come to us and say, right, we want to put some ads in the paper. What they really want to know is, we already have all of your customers, but we want to get those customers, those fair weather fans who just want to put a bet on England versus Italy, and they'll never come back again until the Grand National arrives. So what we would do, we would take our database of those customers who are interested in England football content, and we would match it with the other gaming database. And usually what you would find in that Venn diagram is a gap, which would be maybe 10, 15, 20,000 people. Those would be the individual customers and readers who you would serve the ad to. Those are the one-off people who would maybe put a £1 bet on the outcome of the game. That's why you're seeing 46% uplift. We're much more clever and sophisticated in how we target our customers now. Now, I spoke to you about we can't do this without our people. And the pandemic has put a real burden on a lot of our staff. We've got people working from home who may have been based in London who are flat sharing, but we still expect them to do their job. And we've even had examples of quite a few of our team who are working from their hallway because they're flat sharing. It can be quite difficult. So we have invested, and again, because we can, of our operating margin and well-being for everyone. We have provided Sanctus and Headspace spaces and appointments for anyone who asks for it. And I and Simon personally have said, if we reach the capacity for access to a mental well-being coach, or even just someone to listen to, which is the Headspace element, then we will make sure that that provision is provided for. So if anyone wants to speak to anyone, they can. And these support networks have been heavily invested in the business. We've also appointed, after the George Floyd issue, our first director of diversity and inclusion. We never had that before. And we've actually put targets in both the executive and the board's remuneration and made them public about where those remuneration and targets used to be. So we will have ethnicity, we will have gender targets in the business. Everyone says this not before time. I completely agree. I'm doing it now. We're not hiding behind it. We're making it public. We will be judged over the next coming year on whether or not we've delivered on them. And we are happy. Simon and I are both happy to commit to that. Investing in journalism. This is essentially what we're all about. Okay, I make sure our editor-in-chief stands shoulder to shoulder with Simon and I on the interim results and the full year results. And the reason why I do that is that you can't buy editors. You can't buy Simon and I either, but we're here to grow value and make money to invest it in the business and to reward our stakeholders who have supported us. But our editor isn't interested in that. All Lloyd is interested in is journalism. And so for the first time since 2019, and probably for the first time in a decade, I think by the end of this year, we'll have more journalists than we ever had. That's growing our audience by 8%. Our page views are going up 24%. The time that a registered user and an overall user on the site is up 50%. And because we're providing more journalists, then 62% more stories have been published. Obviously, our editors are delighted. What I'm trying to say with this slide is the editorial and commercial aspect of the business are actually tied into the same objectives. Because if that's not the case, you can't grow success. And that's why I asked Lloyd to join us on stage to say, tell everyone about the editorial involvement in the business and how it's helped us grow it. That will continue to be the case because that's where our success is based. And what does that actually mean? Well, the more journalists we have and the more stories that we create, then the bigger the audience we have and the more loyal they become. And the more loyal the audience becomes, the more data we can find out about them. And the more data we can find out about them, then the more revenue we can actually take from that audience because we are getting more targeted advertising, which delivers a higher yield. And that's the circle of success. That's what's delivered the operating margin. That's what's delivered the growth, the 43% growth in digital. And that's why we're committed to more journalists in the business to deliver more content, to basically deliver more data. So the company's now on the path to long-term sustainable growth. We had actually said this last year, but now we're showing the investors the evidence of that. A lot of our investors backed us because they've seen this happen before. They had trust in us as a management team, but we actually hadn't delivered anything, to be frank. Now we're delivering it. These are the first numbers that show we're delivering it. The audience is growing. That's evidentially supported and becoming more engaged. The investment in content and data will help us accelerate that. You don't get 43% audience growth without understanding them. And now we have an efficient operating model. We don't have to go and buy other declining print assets to squeeze out synergies to buy us another 18 months. We are now sufficient to transform our business. And as Simon says, that's coming through in the cash flows. We have a good credit facility, but we don't need it. So now we're looking at what we do with that cash flow. Obviously, we'll reward our stakeholders. Obviously, we will invest in the business, but it also gives us opportunities if we're looking at M&A. So look, thank you for your time. I'm going to hand back to the chair for any questions.
Jim, Matt, Simon, thank you very much indeed for updating investors this afternoon. Please could I ask investors to continue to submit their questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review questions submitted already, I'd like to remind you the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard, and again, we'll notify you when they're ready for your review. Finally, I'd like to also remind you that your feedback is important to the company, and immediately after this presentation has ended, we'll redirect you for the opportunity to provide feedback in order the company can better understand your views and expectations. Matt, Jim, Simon, perhaps I could, in the first instance, Matt, hand back to you, just obviously because investors had the ability to pre-submit questions, and of course, you've received a number of questions during the meeting itself. Perhaps I could just ask you to read out those questions and, where appropriate, give a response. That would be great.
Sure, thanks, Mark. The first one we've had in, which is probably for Jim. Your valuation over the past year has seen Reach move from a 2x multiple to around 9x. What do you think the market now sees that it didn't a year ago? And do you think there's still more to come in delivering the strategy?
Well, what the market sees what it didn't before the market liked our strategy, had seen it working before, understood the logic behind it, but they actually hadn't seen the evidence that had been delivered. So a lot of our investors had confidence in Simon and I and the team that we could deliver it. Others basically waited to see. Those that had the confidence are now being rewarded. And now what they're seeing is the evidence of that. So the evidence of data insights delivering value, which is why we've grown our position and obviously creating more interest in the company. But one important thing to say, we are only in the foothills of the progress that we're making. So the assumption that, well, you may think we've missed a chance, we're not. We're still at the foothills of what we're doing. I'm now just showing some of the proof.
Good. And I guess following on from that, another question which asks, could you explain why you're investing more and what you're investing in? I think you've talked quite a lot about the investment in journalism. Perhaps we might want to talk a little bit more about the investment in data.
Yeah, we're investing a lot in data platforms. So the ability to actually hold the data in a legal form and in a good order, and then to run the algorithms on it is actually a platform. It's called Blue Ven, and we invested in that about 6 months ago. And then obviously we're now employing data statisticians, software engineers, data analysts. So as well as the journalism, it's the data platforms and tech skills to allow us to make it happen.
And perhaps this is one I can direct at Simon. Is this just about replacing print revenues with digital? How should we think about the prospects for the print business with more and more people switching to online? And perhaps just a little adjunct to that one that's just come in. Will costs start to rise as a proportion of declining circulation and print advertising? And if so, when will it hit you?
Yeah, I mean, as thanks, Matt, and thanks for the question. I think in terms of the print business, it's still a scale business, and it continues to be a highly cash generative and very efficient business, and will be for many, many years to come. So whilst the focus of the customer value strategy is about accelerating our digital progress, we can do that as complementary alongside continuing to deliver a very strong print performance. We've seen during the pandemic the print business be extremely robust. In fact, we've talked about the fact that we were between 93 and 94% of our original budgeted circulation in the year 2020. So in a year where we've been so restricted, we've been able to really deliver in 2020 on the basis of our certainly the vast majority of our original budget, and clearly that none of that contemplated COVID. I mean, in terms of the cost base and how that evolves, we will see a continued transition of our cost base as we become more digitally focused. And therefore, we will see more investment go into areas like data science. But we don't have to worry about diseconomies of scale for our print business, given how efficient we are, certainly not for many, many years to come. That was why we did the transformation.
Excellent. Very good. Another question that's come in from a couple of different viewers. Can you comment on the relationship and the payments received from the social media companies and the likely trajectory over the next few years? Probably one for Jim.
Well, look, we have quite a strong relationship with Google and Facebook in particular. On Google do the open market, they trade our content, and the revenue that we get from them is valuable, and the same with Facebook instant articles. The relationship that we have is that we will work with them commercially and positively, and we have frequent meetings with them, but we reserve the right to lobby government because we think we should get more. And they obviously disagree, or at least they don't want to move. So they know that we speak with government. They know that we lobby for more. We think they should be paying their fair share, but it never gets to a point where we fall out. We're not intending to take them to court. We're going to use government lobbying, etc., in order to get a fairer share of that. And also, we're not preparing just for that. We're also building our own Reach ID, which is our own relationship with clients, so we don't rely on Google and Facebook for them to share customer data, which is one of the bases for the strategy. So it's a healthy commercial relationship, but it doesn't mean that we can't challenge them publicly or with government and the regulators to pay us more.
Excellent. Very good. Thanks, Jim. One on cash, which possibly both of you might want to say something about. Firstly, sort of two-part question. Are there still more newspaper brands out there you'd like to acquire? And sort of allied to that, you're generating increasing amounts of cash whilst also being able to invest in the business. What are your thoughts on future uses for cash? Should we be thinking about increased dividends, or do you have other plans?
Shall I start with that, Jim, and then you'll add to it?
No, you can answer it both, Simon.
No worries. I mean, in terms of our cash performance, I mean, and specifically talking about traditional assets, for people who know our history, you'll be familiar with the fact that we bought a large regional business in 2015 called Local World, and we bought a large national business, Express and Star, in 2018. And those two together are key components of what Reach is today, a scale business, as Jim opened with that huge digital audience and print audience. We don't need more scale to deliver our strategy. So we have no need to go and buy other newspaper groups. We have no need to go and acquire or consolidate other parts of the industry. We have got a sufficiently large audience to be able to deliver our strategy. Now, that doesn't mean we wouldn't contemplate it at the right pricing, but it's fair to say that we have no need to do it in order to continue to progress. In terms of the uses of cash, I mean, we see that the £55 million of net cash that we have now as a business gives us optionality, whether that be to invest more organically to further grow out our regional presence, or to invest more in national content, whether it be about further developing our platforms, our mobile apps, investing more in customer data platforms, or whether it be to scan the horizon for other external things that may accelerate our strategy. We don't write any of those off as opportunities, and continue to pay a growing dividend. And it is our focus to grow that dividend. If you look at the track record since 2015, other than in the COVID year where we were cash conserving, we've continually grown that dividend, and we've rewarded shareholders for holding our stock.
Very good. I've got one final one, maybe in the last couple of minutes before 6:30. I've seen lots of comparisons out there between yourselves and Future. Do you feel that's a fair comparison? Could you perhaps talk about any similarities or differences that you see between your businesses?
Well, there are similarities with regard to, we use customer data to increase the propensity to do something, right? But Future and I are different business. Future and us are different businesses. They are obviously content into e-commerce. We're content. So there are similarities in the use of data, but we are not an e-commerce business. We may have some e-commerce peripheral partnerships, but we are all about content. So the data side is common, but that's probably where the similarity ends. The use of data to enhance your business is probably the common factor.
Matt, I don't know if it's an opportune moment for me just to come in, because obviously I think for every question you answer, there is another one that comes. So I think I could keep everybody here all day. But thank you to all the investors that have taken time to submit questions today. And of course, the company will review all questions, and if appropriate, we'll post responses on our website. Jim, I know feedback is important to you and to the company. And perhaps before I redirect investors to provide you with feedback, I could just ask you for a few closing comments, and then, as said, I'll direct investors to feedback.
Yeah, well, I thought two things. One, to say I think we are ahead of the curve where we expected to be, and that's encouraging. So hopefully investors will bear that in mind. And the last thing is, we know there's a lot of places where you can put your cash, and we appreciate the time that you're taking to just have a look at us. We don't take anything for granted. So thank you very much.
Jim, Simon, Matt, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Reach PLC, we'd like to thank you for attending this afternoon's presentation. That concludes the session, and good afternoon to you all.